this oil chart breakdown is telling me that the U.S. economy is starting to slow quickly.
Okay. Overall, then, what is your most bullish asset for this year still?
So bullish asset, I would say. So I'm going to give you a new one. Okay. So
Markets are up today on Wednesday, May 15th, on the back of a slightly softer inflation report compared to the previous month. We'll be talking about inflation expectations, Fed monetary policy expectations, and interest rate expectations with Gareth Soloway, Chief Market Strategist at VerifiedInvesting.com. We'll also be breaking down Gareth's new outlook for stocks, Bitcoin, gold, the dollar, and much more. And Gareth will be revealing to us his new sleeper trade of 2024, what he believes may be the most bullish asset of the remaining couple months of the year. This episode is sponsored by NordVPN, so stay tuned for a message from NordVPN. Really interesting product. Gareth, welcome back to the show. Good to see you again.
thank you so much, David. Always a pleasure to be back with you.
Always a pleasure to have you. Wanted to get you on today because CPI and inflation numbers came out. So U.S. producer prices increased more than expected in April. Cost of goods and services rose sharply. Now, this has had an interesting effect on the markets because I'm looking at the screen, which you'll show later, I'm sure. Everything's up. By everything, I mean stocks, Bitcoin, even gold's up. Gold's up 1%. We'll talk about Bitcoin's up 4.5%. The Nasdaq's up a whole percent. So huge move for the markets today. Why the positive sentiment reacting to today's report, you think?
Yeah, so you're right. A couple days ago, we got the PPI data that came out hotter than expected. But the key in that report was that they revised last month's PPI to a negative 0.1%. And so again, the psychology of that report, basically what that did was it made everyone assume that the report we got yesterday on PPI would be revised down next month. So that wasn't a huge negative. And PPI, in all fairness, is not as important as CPI data, which is what we got this morning. And that came in slightly better. Month over month, I think it was expected to be 0.4%. It came in at 0.3. Year over year came in at expectations. And the other thing to keep in mind is that psychologically, we had been, as an investing class, as everyone is investors, we had been conditioned to assume it was going to be a hotter number because the last 3 months were hotter than expected. So the mere fact that this report came in line or slightly better is basically a sigh of relief, if you will. And that allowed the markets to have this relief rally today.
Year over year, though, Gareth, the number came in at 3.4% headline CPI. It doesn't look like it's gone down significantly since the previous month of 3.5%. Inflation is still sticky above 3%. You talked about this. You told me it's not going down to 2% anytime soon, and it's not. Doesn't that mean that the Fed is not going to cut rates anytime soon as well? Shouldn't that be really bad for the markets?
Yeah, so the thing is, it's all about conditioning, right? Just a couple weeks ago, we were all wondering, is the Fed going to have to raise interest rates? And this report, you're right, we're still in that 3 to 4% inflation year over year zone, but at the same time, people are just relieved it is not going higher at this point. And that's basically throwing the market or investors a bone at this point and just saying, hey, listen, at least it wasn't worse than expected. And that's enough in this environment where the meme stocks are going nuts and everyone is all about risk on. S&P new all-time high, NASDAQ new all-time high. It's enough to kind of keep the bullish sentiment going, especially after Jerome Powell's comments yesterday, where he basically said, hey, no more rate cuts, or I should say no more rate hikes. Yes, we're not going to cut anytime soon, but later this year we will. And again, that's what the market wants to hear. Any positivity, anything that's not a negative is taken as a positive right now.
On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. So goods and services, like I mentioned, were a big contributing factor to a hot or relatively hot inflation report, both PPI and CPI. What was not hot is energy. Energy continues to kind of trend sideways. What's your read on oil right now?
Yeah, actually, oil has just had a major breakdown, and so it's kind of in this borderline zone. And let's look at the chart here because I think this is worthy of taking a quick stab at it and just kind of seeing what we have. So right now you can see this was a 50% retrace zone right here on the U.S. crude oil chart. But look at what's happening. We have a bear flag and we're beginning to downtick just a little bit. And so according to everything I'm seeing, and we can remove this off the screen here to make it even clearer, is that we are now borderline breaking and in the process of breaking this key support. And so I actually think that oil is going to go down. But the key is this, is that everyone assumes oil is going down just because it's going down. I think it's going down because smart money knows that the U.S. economy is slowing very quickly. And I also can attribute Jerome Powell's comments yesterday where he was surprisingly dovish compared to what the PPI data had shown. And to me, I think he knows that the U.S. economy is starting to slow quickly. And thus he is kind of saying, hey, listen, I can't tell you we're going to cut a lot because inflation is still high. But at the same time, we're certainly not going to be raising anytime soon. And therefore, the markets, again, are happy. But again, this oil chart breakdown is telling me that the U.S. economy is starting to slow quickly.
Are you then saying that inflation is not going to go up much because energy is not the outlook isn't really hot right now?
Yeah. Yeah, so basically what I'm expecting to happen in terms of my forecast over the next 4 to 6 months is that inflation's going to kind of peter out here in the 3 to 4% level. And I really do not see it going much higher than it currently is. I even think it might downtick a little bit based on if the stock market comes in a little bit, based on energy coming in a little bit. I even think copper. I mean, copper is looking like it's toppy here, and that could start to reverse dramatically. And these factors will basically stall out inflation. But again, I would caution people is everyone hopes that inflation's going back to 2%. It is not. You're going to see it sticky around 3%, but I do think it could come in from 3.4% back to 3%. And the Fed will, essentially that'll give them room to cut once or twice, but not the full amount that the market hopes down the line.
I think the market more or less agrees with you. I'm looking at the TIP, the Treasury Inflation Protection Security ETF, and it's just more or less held steady around 106. So it doesn't expect it to go up or down either way, inflation that is. What are your interest rate expectations then, Gareth?
So I do think they cut in September. I do think by September we fully see a pretty significant slowdown. And I think one of the things to keep in mind, and I hope investors are kind of monitoring this, but I mean, think about Starbucks earnings, DoorDash earnings, Disney earnings. I mean, you could go on and on the list this past earnings season of consumer-led stocks that, again, require consumers to spend money. They all saw negative earnings, or at least the guidance was very, very weak. And the stocks took huge hits. I mean, Starbucks was down one of the biggest moves, as was Disney, that I've ever seen personally in my trading career. And so these are signs that the consumer, which is the backbone of the U.S. economy, is finally starting to kind of stall out. And that will slow the U.S. economy into recession by late this year.
So you're still sticking with your recession call. Can you give us some recession indicators that you're looking at right now?
Yeah, so ISM services is a big one that's gone below 50, and again, anything below 50 is a contraction. I'm looking at the slowdown in GDP. GDP was less than expected recently. Non-farm payrolls less than expected, and I think the big one that I'll be watching Thursday morning is the unemployment, the initial claims report. Last week we saw the highest level of people filing for unemployment at 231,000 since August of 2023. If that does not come back to 220 or below, I think you have a new trend here of people filing for unemployment and more people being laid off, and that will signal also a recession down the line. Remember, the economy moves slowly, so it's not going to be instantaneous, but I do think by end of year, we probably are in recession.
By the way, consumer sentiment more or less mirrors what you're saying right now. The recent consumer sentiment report from the University of Michigan came out a couple days ago, last week actually. And for May, it posted an initial reading of 67.4 for the month, down from 77.2 in April, and well off the Dow Jones consensus call for 76. So consumer sentiment is sliding faster than expected. I guess, part of the reason is inflation remaining sticky. Part of the reason maybe, I guess, the Fed not cutting rates anytime soon. Is there perhaps another reason for why consumers aren't feeling great right now?
Well, I think it just comes down to inflation, right? I mean, you look at the cost of car insurance, the cost of rent, the cost of food, the cost of energy. I mean, all of these factors are just at this point weighing down the consumer to where even though jobs have seen wage gains, right, where people are making more money, it's not overcompensating. In fact, it's a deficit from what they're paying, and it's incredible to think about. I mean, just to put this in perspective, just recently, Boston Market filed for bankruptcy, as well as we've seen. I actually just read last night that Red Lobster's looking to file for bankruptcy, possibly by the end of this month. TGI Fridays is closing locations. We're seeing all of these kind of fast casual dining restaurants starting to cut back locations or going out of business. And the key here is that it's expensive. I mean, you go out to these places with a family of four, and you're talking well over $100, and that again is unsustainable for a consumer that is strapped paying rent, mortgage rates at this point, and all these other costs. And so it's almost like death by a thousand cuts, to be honest, for the consumer. And finally, the consumer who has run up $1.1 trillion in debt, and then phantom debt of $700 billion by buy now, pay later. At some point, that's unmanageable, right? You just can't do it and just continue to pay these bills. And I do expect default rates to rise on credit cards pretty substantially over the next 6 to 12 months as well.
Okay. Before we talk about the broader markets and Bitcoin, I want to get your thoughts on this. So Wall Street Bets is resurfacing this week. Roaring Kitty is making news online. Reddit shares jumped 7% on Tuesday, following GameStop and AMC soaring again. I mean, these are like dead companies that are just popping because people are squeezing them. Are you getting on this? Are you following this? Are you getting in?
So I've made a ton of money on the short side on these, to be honest. I think I went long a couple times on them, made a small amount of money, but the majority of the money that I've made as a trader has been going short. And again, part of it is just understanding human psychology. So when basically what you had is a scenario where 2 years ago, 3 years ago, actually in 2021, many of these players got in and it was the hodl, like do not sell no matter what. And a lot of them saw, AMC went to hundreds of dollars, right? GameStop went over $100 and change, and then it collapsed to $10. And so anyone who held on and did not unload, they got crushed on these trades. And so what happens is when the reemergence of this trade occurs, psychologically, all those people might be getting back in, but in their head, they're like, hey, remember what happened last time? I'm going to sell before the top. I'm going to be one of the first people out of this trade. And what that does is it creates a massive amount of selling pressure on the way up. And so what we've seen is AMC is down already over 50% from its high just yesterday. GameStop, same thing, basically down 50% from its highs yesterday as well. And that's psychological. So for me as a trader, knowing that, I can get in on these and make a significant amount of money to the downside.
I'm not disagreeing with you, and great job. But I'm just going to push back slightly on the assumptions here. You're assuming that people have good long-term memory. They remember what happened last time. I think if anything history has taught us is that people don't. Right? People have short-term memories. They don't remember the mistakes they made last time. They're going to repeat the same mistakes.
Right. And you're right. To some extent, that's true. But I do think that when you watch a significant amount of money vanish from your portfolio, there is a little bit more memory. And I think the same thing, like if you saw Dogecoin rallying up towards its highs where it was in 2021, you wouldn't see the same momentum continue because the same thing. A lot of people saw that investment just evaporate on them and bring it back down to these levels. And they're not going to make that same mistake twice generally. Some will, but a majority won't.
Do you as a trader follow Reddit and social media just to get in early on the next meme stock? Is that your thing? Do you do that?
No, and that's a great question. I don't do that because by the time I'm hearing about it, I'm already late to the party. I'm a big believer that I need to be one of the first people in a trade. If I'm one of the midpoints or later on, the risk of it going against me is too large. So by the time it's trending, let's say on Reddit or Twitter, I'm probably late to the party already, and I'll just skip it.
Well, tell us some of the trades you're getting in on this week.
Yeah. So today, we played Dell a little bit. Dell is having a monster move on an upgrade. I actually was able to short this and make a little bit of money. I actually think Dell is a great swing trade as well. if we take a look at this chart, it's just had an amazing, absolutely amazing run to the upside. But again, what you're looking at is a chart that is now starting to show significant traction in terms of being overbought. And so today it was an upgrade, I think, from Morgan Stanley, talking about how they're going to be key in the data center, building out these type of things. But I look at the chart and I say, listen, to me, this stock, like just going back to, a year ago, this was trading at $40 to $50. It's now nearing $150. To me, this is an overdone chart. The metrics are telling me we're likely due for a pullback. So these are the types of trades that I'm getting into right now. I'm starting to accumulate some of these shorts. I continue to think that even with the S&P up where it is, I do still think that we're at a point where we probably see a significant decline. In fact, here's the S&P chart. Take a look at this trend line from the all-time highs of 2021. If we look at the high recently, look at what we just tagged today. Match that up with the VIX. The VIX is incredible in terms of the decline. And for those of you that don't know, the VIX is the fear index, and the fear index just in the last basically 3 weeks has gone down over about 50%, which is telling us there is no fear in this market, and that makes me fearful when no one else is fearful.
Okay, let's talk about the broad markets then. So S&P 500, NASDAQ continuing to break new all-time highs. We had a pullback in late March, and more or less it's more than rebounded from that. So what's happening right now? Are we seeing new highs going forward as well, you think?
Yeah, so just looking at this, as you guys can see, so this is a couple key analysis points that I really reserve for kind of top investors, but I want to share them with you guys. So number one, we are making a new high on the S&P 500, but the things that have me concerned, number one, you have this trend line here. So we have a trend line that we are hitting on a short-term overbought scenario. But if we throw up our RSI on this, and this is the relative strength index here, what we can see is that you have a negative divergence. So again, if you look at this daily chart, here was a high and we're making a higher high, but on the RSI you have a high and a lower high. If we flip over to the weekly chart, it's even more pronounced here. Take a look at this negative divergence. You have a high on the weekly, a higher high now, and you have a high and a lower high on the RSI. Relative strength to me is a guide of what big money is doing. It's telling me that even though the markets are going up, smart money is unloading into this, and it does make me nervous about the potential for a drop. The other thing to just keep in mind, a lot of investors will say, hey, we're making new all-time highs, so let's rev the engines and we're going to go a lot higher. I just want to remind people that many charts perform this way. What I mean by that is you get the big bull run, you get a big correction, and then you make a new high, and then everyone assumes it's continuing to go higher, and there's a rug pull where it collapses. And just to remind people, look at this pattern formation. Imagine this is the chart here. We go up, we go down, we go up, we make a new high, and then we get a big drop. If we go to Bitcoin, let's go to the Bitcoin chart here. Let's see what we have on this chart. So if we go to the Bitcoin chart and go back to 2021, the exact pattern played out. Here it is. You had the big run, the corrective move. We made a higher high on Bitcoin, and then we collapsed down from 69,000 to 15,000. Then let's look at natural gas. It's another one that comes to mind, but there's so many of these chart formations. But look at the natural gas chart back in 2022. There's your run up. Big correction, a higher high. So everyone thought, oh boy, this is a breakout. The stops got triggered on bears, on the shorts. And then look at the collapse that we saw after that, natural gas coming down. So these are the types of patterns that I look at over and over again. And they essentially keep me honest with what to expect. So I don't get too bullish or too bearish. I kind of be conservative and start looking for these types of patterns to play out over and over again.
I would just say that yeah, these are patterns that recur over and over again, but natural gas is a lot more volatile than something like the S&P, right?
Right. Natural gas collapsed 87%. I don't expect the S&P to correct 87, nor I think Bitcoin went down about 75%, and I don't expect the S&P to go down that much either. But would a 25% correction be out of this realm? No. I mean, we had one of those essentially in 2022. And so I do think if we do head to recession and the Fed can't cut rates as aggressively as the market wants, at some point we're going to see a contraction in the multiple, the S&P multiple, as it'll have to come in as consumers, again, are going to stop spending.
Let's suppose this recession happens towards the end of the year, like you predicted. Do you think the market's going to sniff that out before we officially get the numbers?
Yeah, I do think so. I really do. The market is very smart in terms of forward looking. And so it usually will sniff it out about 3 to 6 months in advance. So it kind of puts us in line with maybe getting close to this all-time high, this trend line on the S&P. And then if we do roll over, I don't think we're in a recession till later this year. But I do think, again, big money is very cautious right now. And again, we're seeing, people like Jamie Dimon cautioning everyone about the U.S. debt. I think that's an overhang. He's not really talking about the Federal Reserve. I don't think he wants to step in that pile of, what, at this point and kind of criticize the Fed because they look so good right now. But I'm sure he's thinking about it as well and keeping close eye on inflation.
Yeah. One thing I keep seeing in the comments, even on my own videos, is look, why all this report on a potential recession or negative news in the economy where all these indicators that we talked about already, markets continue to make all-time highs. Clearly, markets are ignoring some of these signs that we're talking about. How would you respond to this?
Yeah, and so the important thing is to look at every past big drop in the markets. And you could go back to 2021, where we were making new all-time highs almost daily, and then all of a sudden we corrected, 27% on the S&P. You could go back to 2007, where, there was plenty of people sounding the alarm on the real estate financial crisis, but then the markets continued to make new all-time highs for literally months before we collapsed. And so what I've learned is that it's much more about kind of momentum. Investors will chase and be FOMO'd into positions for periods of time, even when they shouldn't be. And that carries the markets much higher than you think. And then at the same time, at the lows, they panic and sell at the lows, carrying markets much lower. But there's usually a change that the smart money essentially sees, and that's where you want to follow. I mean, essentially, that's what I try to do, is look at the charts to give me an inkling of what we're seeing from big hedge funds and kind of the best people, the David Teppers of the world, those type of players.
As a swing trader, do you look at valuations, PE ratios, EV/EBITDA? Those indicators is that part of your toolkit or no?
So not so much on a swing trading basis where I'm holding for a week or a month, but if we're looking at a mid to long term trade, let's say 6 to 12 months, then absolutely. Because really what you're trying to do as an investor or as a swing trader is you're trying to get as many factors in alignment as possible. So first and foremost, it's all about the charts, double tops, trend lines, etc. But then if you can kind of back it up and say historically price to earnings multiples are extended here, plus I'm seeing multiple bearish things in the charts, that's always a helping hand for your thesis.
But let's say you have a stock that runs up. I mean, it doesn't matter which stock. It's run up a lot, and you think that momentum's overbought. You should start shorting, right? But then relative to its peers, its PE is still relatively low for whatever reason. Do you then look at that and say, well, it may be cheap compared to its peers, I shouldn't short? Does that thought ever occur to you?
Yeah, absolutely. So you definitely want to pay attention to anything. Anything negative has to come into your analysis because if anything's going against it, you can't just ignore it. You have to take it into account because it's a risk factor, and understanding risks in any trade are super, super important. So there's no doubt about it that I do take it into account. It doesn't mean I won't make the trade, but sometimes what I'll do is, let's say I was going to put 100K in that trade, maybe I'll do 50K and go a little bit lighter because I know there's additional risk. So there's lots of ways to kind of maneuver on a trade or an investment where you can mitigate risk but still get some exposure.
Okay, so can we pull up the charts once more, please? And let's take a look at the NASDAQ. We'll finish off on the overall stock markets here. So like you said, momentum has been strong on the upside. Why not ride this momentum and continue? I know you think there's going to be a recession later. I know you think that markets are topping, but right now, as we speak right now, wouldn't you stay long or no?
So no. In fact, just in the last week or so, I've been accumulating some serious long-dated put options on the NASDAQ 100. And again, I'm talking literally 2 years out. So I've got a lot of time. But then when I do options, that's what I do. And then, yeah, I continue to kind of play the inverse of this, and again, I'm looking at so many different factors where you look at the VIX and how low that is and how little fear there is, the momentum and the chasing that's going on today with this, everyone's saying, oh, wow, it's great on inflation. But let's not forget the 0.3% month over month number. If you annualize that, that's still 3.6% inflation on a yearly basis. That is very, very high, high enough to make it so the Fed cannot cut rates when this market does get into trouble. I then look at earnings and I say, okay, what is Disney saying? What is Starbucks saying? What is DoorDash saying? What is, Expedia saying? All of these are telling me the consumer, which is again the backbone of our economy, is stalling out. So I always try to get ahead of the moves. And when everyone else is bullish, more often than not, I'll be slowly inching into the short side. Just like when everyone's bearish, I'll be slowly inching into the long side.
Okay. So right now you're saying it's a little bit too late to get in on the action.
Yeah, I mean to the upside, I think
upside.
the party is in the ninth inning, if you will. Doesn't mean we can't go a little higher. Maybe it goes to extra innings, but at this point, you start to look at trend lines like this. Like this would be a very powerful trend line on the Nasdaq, where if we continue up, it's somewhere in the 19,000 range, 500 points away. But for the risk involved of a dump of 1,000 or 2,000 points to get 500 points out of it on the off chance it goes there, as an investor, it doesn't make sense to me.
Okay. Let's take a look at the Bitcoin price then. I suppose it's a similar story to the Nasdaq. They've been closely correlated, but let's take a look there.
Very closely. The only negative to Bitcoin right now, and there are some positives, I want to be clear on that. In fact, the chart itself is bullish, right? It is neutral to bullish on the chart. But the negative is the Nasdaq's hitting all-time highs, the S&P's hitting all-time highs. Bitcoin right now is not. So it is lagging the risk-on factors here. Now, the bigger question would be is if the Nasdaq drops 10%, does maybe Bitcoin not drop 10%, in which case that would be a positive for Bitcoin. But right now, it's lagging. On a positive side, there's a channel here on the chart. And this is known as a bullish channel. It's a big move up with a lot of digestion. That's what creates the channel. You can see the lows align and the highs align. And so basically what you're looking for is a breakout above 69,000. If we can get that, then Bitcoin probably rips right to 74 and honestly probably even higher. But in general, if you looked at 100 of these patterns or 1,000 of these patterns, these sideways channels after big runs, I would say about 75% of them break to the upside.
Wait, sorry, can you just explain how this is a bullish channel for those of us who aren't pro swing traders like yourself? Yeah, like it's swing, like it's going down, right? Like the trend is downward. How
Correct.
Is it bullish?
Correct. So what you do is you look for the bigger move. So what was the bigger move? We went from about 38,000 at the low here after the spot ETF, the fall, and we went all the way to 74. So the bigger move, the kind of like the dynamic or the major move was to the upside. And then you're getting a lot of sideways, essentially digestion. Think about this as a marathon. So a runner started down here and ran the marathon. You can't say, hey, go run another marathon the second they finish. What do? They pause, they sit down, they refuel, they eat, which is the consolidation pattern formation. And then they can make their next run to the upside and go on their merry way. So I think that's really important. This is what we call a classic bullish consolidation channel pattern.
Okay, so you are, I guess, short-term neutral to bullish on Bitcoin. Then do you have a target for us?
Yeah, so basically what you're looking for, so you're neutral to bullish right now because you're inside, which means you can still bounce around inside of here. You could go down a little, you could go up a little. The bear case would be any sort of break of this low channel line right down here, which is around 56,000. That would be a failure of the bullish pattern, and you'd probably get a move down to 50K on that. Now, if you can break to the upside of the channel, which is around 69, then all of a sudden it's game on, full out bullish, and you'll stop maybe at 74, the all-time high, but I even think it blows right through that and continues up much, much higher.
Interesting. I've talked to you for a long time. This is the first time in a while since I've spoken to you that you've had this kind of sentiment on Bitcoin. Why the change in over the last couple of months? You were more neutral to bearish, I remember.
Yeah, so when we were at these highs, right, when we were up at 70, it's probably one of the last times we talked when we were up in near these all-time highs. It was an extended move. We were into significant resistance on the chart. In fact, if you go back here to the previous all-time high, I remember one of the theses that I gave you was that the previous high here in 2021 was 65,000, and we made a $4,000 higher move to 69,000. And then if you add 4,000 to 69, you get basically 73 to 74. So after such a significant move on Bitcoin straight up to 74, it made sense to be bearish, neutral to bearish for a pullback. But now again, as we digest and we're not collapsing, it starts to make me a little bit more neutral to bullish. Now, again, just please understand, everyone, because this is key. If we do break this lower trend line here, then that kills the bullish side, and the bears essentially take over for a dip down to 50 at least.
Okay, so it's just a matter of seeing how this channel breaks out, either to the downside or
That's
upside. That
right.
makes sense. But if you look at the two prior peaks, though, both peaks have been followed by this massive decline, right? This crash. If you
They
just
have
zoom
been,
out
they
a little,
have been, and I think
yeah. So
the bear case in my head. I mean, again, this is kind of not saying the chart itself is the chart. My only bear case for Bitcoin, where I could honestly see it go back to 50 or even 30, would be if the stock market really collapses. Like if you told me
okay,
in 12 months from now the Nasdaq is down 40% off of its highs, I would be
sure,
like, okay, Bitcoin's probably at 30,000 right now. But again, that's only contingent if we see the risk market start to collapse down.
yeah. And I think it was interesting because the first time Bitcoin reached new all-time highs in 2021, I don't think the stock market was collapsing then. I don't remember. I can't. I have to refresh my memory. I know it was going down in 2022. I don't remember what it was doing in 2021. The first time it had that. Do you remember, Gareth? The first
The
time it had
first
that
time,
drop.
so I don't remember right off the bat, but the beauty of it
Let's
is we can
check.
just
Yeah.
jump right back to the charts in 2021, and what we could see is there was, I mean, no, to be honest, it wasn't. I mean, it looks like
That
there
was the
was
yeah,
a,
that was interesting. I think that was the only time that in the last couple of years where Bitcoin and stocks kind of just really diverged.
yeah, you're right, you're right. You had the big correction in Bitcoin, and then the stock market had small pullbacks, but it was nothing of major, effect. And then we saw Bitcoin recover very quickly and just move right back to new all-time highs as the S&P went to all-time highs.
Why do you think after that Bitcoin started correlating a lot more closely with stocks? Is it
I have a feeling it had a lot to do with money in the system, right? So the
okay?
bull run of 2021 was coinciding so much with these checks that were going out to Americans
Sure.
from the US government. People were home, they had so much money, they were just sitting behind their computer. And so you really had this scenario where money just flowed into the Robinhoods, into stocks, into crypto. But at some point crypto got too bloated and it had to correct. And so a risk asset like that had that big middle correction down to 30,000, but then it quickly recovered as the bull market in stocks and money was still so positive out there. The flow and the printing presses were going.
Okay, can we leave this charts up, please? Let's move on to gold.
Hmm.
Another interesting asset that's been moving now, consolidating above $2,300. What is going on right now? Can you tell us about the channel it's making?
Yeah, absolutely. So again, here was your previous breakout, and this is something when I came on with you at the start of the year, it was my call that we were going to see a big breakout on gold. We obviously
Hmm.
got that in the last, really at the start of the year, we got the breakout. Now, what we're seeing here is basically gold has had a huge run up from essentially the 2075 break to a high of 2024 and a quarter, and now it's been consolidating. So much like Bitcoin, you could make a case here that it's digesting that bigger move. Now, net, you still have to look at the factors here, and this is going away from the charts, but to the fundamentals, where we know the Fed at some point is going to lower rates. We know the government is not going to get their spending under control, and if they did, it would cause a massive, probably depression in the country, unfortunately. And so all of these factors mean that more dollars will be available, and therefore gold ultimately goes higher. Now, does that mean we can't correct back down and maybe pull back to 2,200? I still think that's possibly in the cards. I will be a buyer at 2,200 all the way down to 21, but ultimately I think we're still going to 2,500 and even beyond.
This year, 2,500. We're
Yes, I
net.
still think by December of this year we're above 2,500, or at least have pierced during the next 6 months or so.
Okay. I'm just curious as to how your analysis for gold um isn't applicable for other things because it's run up tremendously above that orange line, right?
Yeah.
I wonder why you're not super bearish just because it's run up so much. And as a swing trader, wouldn't you want to just take the opposite side of that momentum and be like, you know what? It's time to take profits, time to short. Kind of like what you told me about
So
stocks, right? What's different
yeah,
here is what
and
I'm
with
saying.
and with Bitcoin too, right? So and then when
Yeah.
we were at the highs of 74,400. So the answer is I am actually short the GLD, so I do have a short position on that. We're basically flat on this trade at this point, but you're right. That is ultimately the call where you get these blow off moves and then you look for this consolidation phase, you make a little bit on the short
Hmm.
side and then I flip it back into a long. So for me I just haven't flipped it yet. I'm still expecting maybe one more move down. If we look at this, you could almost make a case that it's forming exactly what Bitcoin's doing, right? I mean, if we just put a channel in like this,
Yeah,
you
yeah,
can
that's right.
absolutely see that this would be almost identical which is so crazy. I mean, I love how charts in different assets just replicate this stuff. But here's your, I mean, you could tell me this was Bitcoin's chart and I wouldn't know any different, right? In terms of the formation at that particular time. And just to refresh, we can go back to that Bitcoin chart and you can see big move up, and then we had the same sort of price action. So the essence of it is in the short term, I am neutral, maybe even neutral to bearish on gold, but mid to long term, just like with Bitcoin, I would be on the bullish side.
Okay. Well, keep the charts up, please. Let's talk about the dollar, DXY. And what are we looking at here? Again, big moves in the DXY over the last year, and it's just breaking down. And it's just, yeah, terrible looking chart. Is that bullish
Yes.
though?
No, so right now it's still bearish. You see this trend line here. If we go back to 2022, this high on the dollar connects through these highs. We hit it right here, pulled back, and then broke out, retraced, and this now becomes support. So it was resistance here, here, and all the way back. And what you're looking for is now for the US dollar to continue down until we get back to this trend line. So I would basically anticipate a move back down to 103 over the next week or two. And then once we get to 103, you start getting some serious support on the US dollar. So I still think, yeah, I still think we got downside to go here. And I can even extend these lines out a little bit more. And what we can see is eventually this upsloping line will meet this one, and this will be some epic, epic support. But I still think the dollar has further downside to go over the next week or two.
Okay. Overall, then, what is your most bullish asset for this year still?
So bullish asset, I would say. So I'm going to give you a new one. Okay. So obviously gold, that's been my most bullish one. That's the one that I favored. That's the one that I have. I have a lot of physical gold, et cetera, and longer term gold holdings. And one of them that's a sleeper that I think people are forgetting about is palladium. And if we look at palladium here, I'm trying to bring up the absolute palladium chart here. Let me bring up the actual spot chart here. Palladium. There we go. I love this chart setup. So number one, we've seen silver rip higher recently, testing the $30 range. Gold has broken out. Even platinum starting to make a move. Palladium for me is the sleeper here. It's even rarer. I don't know if people know that, but palladium and platinum are much rarer than gold. They're just not in as high demand. But as a rare hard asset, I love a chart that's at the low end that is denominated in US dollars, right? It's per ounce in dollars. And so at some point, I think palladium is a big mover to the upside and probably moves up, 50% or so.
Based on what the chart, the channel that you've drawn?
Yeah. So you can see this is what we call a wedge pattern. So it's a bullish wedge pattern where it's now making a higher low, even though it's still making lower highs. What we're looking for is a breakout just above this yellow line, which stretches all the way back to 2023. And if that can happen, you should start to get a breakout on palladium. And if we just look at the platinum chart real quick to just kind of touch base on this, is that platinum is actually in that same process. In fact, it's broken out. I mean, look at this move on platinum just in the last 2 weeks, from $900 now all the way to $1,060. So that is a massive move, about 18% on platinum. And I do think palladium starts following platinum and gold and silver.
Okay. Interesting. Because if you go back to the platinum chart, it's just, sorry, yeah, you go platinum? No, palladium. Go back to the palladium chart.
Palladium, sure.
It's just had a terrible 2 years.
Yeah, which is honestly, that's when I love it. Like, show me a hard asset that's a rare metal that has been beaten up for a long period of time. Like at some point, I mean, let's in all fairness, we should be looking at copper here. And what is copper telling us? So copper has had this massive move to the upside just in 2024. It's basically, in fact, let me do this measurement because I think it's that epic, is if we go back to the start of the year, copper this morning was trading up as much as 32% on the year. So all these metals are running. I want to find the one that isn't. Now, copper is also an industrial metal as well, and this thing has gone nuts. So I want to look for the metals that haven't run yet that likely are just being forgotten. That's what I call a sleeper player, a hidden gem.
Okay. Are you short copper then?
I am. Yep. Today looks like a blow off top on copper. I just want to show you this chart. If we zoom out on this, look at this beautiful double top. So we have an extended move into a double top on copper. They hit right there from the highs in 2022. You should get some sort of check back. I have a target pullback of around $4.35. So that would be a pretty nice percentage pullback on copper before it finds significant support.
What are you most bearish on then? We'll end it here.
So most bearish on, I actually think tech stocks and the Nasdaq and the
Okay.
S&P. So I mentioned that I'm accumulating a significant position on puts. Granted, they're 2026s, so they're a long way out. So I have a
Yeah.
lot of maneuverability if we don't fall right away. But really, these levels up here on the Nasdaq are just incredible valuations. Again, unless rates are going back to 2% or 1%, the
Mhm.
valuations are hard to justify. And I think, again, euphoria is fully back in this market based on today's price action. And we'll see a pullback and a pretty significant sell off in the next. I think by year end, honestly, the NASDAQ's down at least 10% off of the highs.
All right, Gareth. You can switch out of the charts now. Tell us where we can find your work and
Yeah,
learn more about verified investing.
absolutely. So come to Verified Investing. Check out the homepage, guys. It is filled with free information. It's basically Verified Investing is a place where I want all the best traders and investors in the world to congregate, to share their knowledge, their education. The homepage is basically all the data that I wish I had on one website going, when I was a new trader instead of going to 20 different websites to find it. So go check it out. It is amazing stuff. There's articles, there's data, there's the Fed Watch tool, there's earnings, there's economic news. Everything you need as a trader to be fully informed with no narratives. It's right there on Verified Investing.
What do we get when we sign up for your service?
Yeah, so my service, I have a crypto service, I have a stock service, and I have a commodity service. And basically, I give out trade signals as well as videos, literally multiple videos a day, where I analyze the different charts. What is the data telling us? And the idea is that it clears away the kind of the mainstream media nonsense of narratives and just is like, listen, this is what the chart's saying. Whether it works out or not, it's all about probabilities. So let's follow the data versus getting the spin on X or on these social media outlets or even on CNBC or Bloomberg.
Some of the new traders coming to you to learn, what are some of the most common mistakes they're making you're seeing?
So one of the biggest mistakes, in fact, there's many, and I made them all myself, so no one should feel ashamed about it. But it's position sizing. So again, people feel like they have to make $1 million overnight on one trade, so they pile in and they leverage themselves up. That always made me go broke. I always blew up my account when I did that. So it's all about small positions, diversifying, and it's basically running the marathon, not the sprint, right? It sucks that it has to take a little longer, but I promise the wealth will be accumulated over time by doing diversification versus trying to hit home runs. Remember, baseball players, the greatest home run hitters, they also strike out the most. And in trading, strikeout means you lose a lot of money. I don't want to do that anymore. I had my fill of that when I was an early trader. So I think that's one of the biggest things there. The other thing is listening and following like these influencers. Like you got to remember that there's ulterior motives there, whether it's pumping something up so they can unload. And so just follow the charts. The charts are unbiased. It's just looking at ups and downs and looking for pattern repetition, which is human behavior, and just letting them speak to you.
Do you find that a lot of traders are impatient people?
Yes, yes, and that's something even I deal with. I mean, when we have a slow day in the markets, I'm like, oh, I wish there were some trades. But the best thing I can do is I always remind myself to exercise my discipline, because discipline is what makes me survive and thrive as an investor and trader. And so to me, I just remind myself, this is a test. Pass the test, the trades will come to you. Don't go searching for the trades. When I search for trades, I lose literally every single time. So it's about letting the trades come to you, where the chart tells me, okay, this is the level. I take it, and again, high percentage time I win.
We have to do another master class for the audience,
Yeah.
one of these sessions with updated charts. Thank you very much for your time again, Gareth. Good to see you. We'll speak
So
again
good.
soon.
Yeah, so good to see you, David. Thanks for having me.
Yeah, of course. And we'll please follow Gareth in the links down below. And see you next time. Thank you for following the channel. Subscribe and like this video.